China market extended the recovery and had done well in 2025, with Hang Seng Index and CSI 300 rallied at 28% and 18% respectively. Initially, the rally was triggered by the release of DeepSeek's model in Jan, which surprised the market as it showed China's AI capabilities, which had advanced to a level comparable to the Western countries. Through the course of the year, China continued showcasing its tremendous progress in the development of other technology, such as humanoid robots, autonomous driving, battery, and biotech, etc. The ongoing earnings beat and upward revision on the growth outlook in those companies had also supported further rally in the market. While geopolitics stated as the key risk to China, the market had recovered quickly from the sharp correction after the Liberation Day tariff shock in April. China's reduced reliance on US market and its dominant position in rare earth provided significant bargaining power in trade negotiation. And market sentiment also improved during the second half of the year after US and China called for a truce. Therefore, despite the relatively weak macro environment and property market, the China market still performed well thanks to the policy support, better growth, especially in the tech sector, and reduced geopolitical tension. We expect the China market to extend the recovery this year, driven by the country's technology focus, policy support on growth, and further improvement in liquidity. Meanwhile, geopolitical tension and property market weakness could lead to some market volatility. We should continue focusing on the long-term fundamentals instead of short-term noise. There are a few points to highlight. Firstly, growth story is back. The policy combo launched in end of September 2024 has sent a very strong signal of major change in policy direction, basically to support the growth, which became the top agenda for the government. The government had put out policy support to equity and property markets, aiming at rebuilding the market confidence so as to stimulate consumption and investment in the private sector. Nevertheless, such growth recovery driven by the private sector won't be an overnight turn, as it takes time for confidence to rebuild, and it also won't be across the board, so we need to be selective while investing in China now. Policy direction is more predictable with higher certainty. Given the backdrop of geopolitical tension, it's important for China to decouple from US and stay self-sufficient in technology. Therefore, policy support to develop technology in the key areas such as semiconductor, AI, autonomous driving, and energy technology would not change regardless of the trade negotiation or geopolitical situation. These areas will become the new growth engines in China in the coming years, replacing the traditional growth drivers like property or infrastructure. In addition, we believe the development of these new technologies was still at the early stage. With more advanced function and applications to come out, growth in these areas should be more long-lasting. So the third factor is deposit migration, which supported the liquidity in the market. Cash and deposit level in China are high. There is an estimation of $7 trillion excess household deposit accumulated since the end of COVID period. Meanwhile, interest rate was still low now, only 1% interest for time deposit and around 2% yield for 10-year China government bonds, versus the better dividend yield in the equity, in particular 2.7% for CSI 300, while some of the high dividend yield stocks are still offering around 5% dividend, making equity more attractive. Therefore, we expect incremental deployment of such excess cash or deposit into equity, given the low interest rate environment and lack of other investment options, especially for some of the long-term capital like insurance money. This will be positive to the sentiment and valuation of the equity market and also benefit the high dividend yield stocks. So in this year, we will continue focusing on the growth areas in the technology, innovation, and advanced manufacturing space, also with certain exposure to the high dividend yield plays in the financials, energy, and utility sectors. With the backdrop I have described, technology and innovation will be an important area where we expect to see more policy support. We like companies with technology edge, innovation capabilities, and also ability to compete overseas. For example, AI. This will include hardware producers of equipment and components, such as server, networking components, and software companies like large language model and AI agent developers, which should all benefit from the rise of AI applications. And also semiconductor. From the chips designer like CPU, GPU, to semi-equipment producers, which played an important role to help China to achieve self-sufficiency in the key technology space. Hence, we still expect material policy support from the government. And also in the power equipment space, it's critical to resolve the problem of power supply shortage, especially in the overseas country, driven by strong power demand growth due to rapid build-out of AI data center. Certain components, like transformer and switchgear, are in major supply shortage, especially in the overseas countries. We believe the Chinese leader will be able to capture the market share at this junction. And also humanoid robot. Mostly in this area, we prefer those component producers such as ball screw, linear guideway, actuators, especially the ones with ability to compete overseas and get foreign orders. And also autonomous driving, including leading EV producers, component producers such as LiDAR and other sensors, basically to ride on the rising adoption of autonomous driving. And also biotech. Given the cost advantage and comparable technology in drug development, Chinese companies should be able to secure more out-licensing orders from the large global pharmas. And also materials. In addition to traditional metals with favorable supply and demand balance, such as aluminium, copper, and gold, we also like new materials that have exposure in the fast-growing downstream sectors, such as gas fabric and quartz that are used in printer circuit board production. And in addition, given the low interest rate environment and potential of deposit migration, we also like high dividend yield stocks. Therefore, we also have certain exposure in the banks, insurance, and oil and gas space. You can see that the opportunities are across different industries, from IT to industrials, materials, healthcare, consumer, and even financial sectors. And also in all the different Chinese markets, including A-share, X-share, and ADRs. Firstly, we do not have a constructive view on the property sector, as we think that the government's stabilization work in the property market is still in progress. Given the relatively high inventory level and low consumption confidence, property prices and sales continued the downtrend last year, especially in the lower tier city. However, the pace has been decelerating. We do not think this is likely to change much, at least for the time being. However, there could still be some small-scale policy support to further control and stabilize the downtrend. With the government prioritizing technology development to reduce reliance on Western supply chain, there is little incentive to reallocate massive resources to the property market or to launch large-scale supportive policies, so long as the downturn in the market does not pose a major systematic risk to the economy. Therefore, we stated cautious on the property sector. We still like the AI hardware space, given the rise of AI applications and Chinese companies' dominancy in the certain areas, among which we see good opportunity in the optical transceiver segment, which is indeed a networking component to bridge the very high-speed communication between switch, router, and servers. The optical transceiver market is in shortage, especially in the high-speed products like 800G and 1.6T transceivers. Although there would be new capacity coming out in second half this year, supply will still likely be tight, especially in the AI-related products. China producers are leading the market with high share, especially in the high-speed transceivers. Most of the upcoming capacity expansion would also be from the Chinese producers, posting potential for further market share gain. Demand growth has been strong, driven by the rapid development of AI, with solid order pipeline from the leading US server and chips producers. Despite the massive share price rally last year, valuation expansion was only moderate, thanks to the material earnings upgrade, which we expect to continue this year, and to support further share price rally. Power equipment in the industrial sector is another area we are interested in particular the transformer market. The Chinese leader focused on the production of high-voltage transformer and switchgear had also expanded into the production of energy storage system. Transformer market is also in supply shortage due to the strong demand growth from AI data center, electrification, and also deployment of renewable energy. However, project lead time for new capacity expansion is long, hence the situation of supply shortage would sustain for some time. The Chinese leader has strong technology edge and also competitiveness in the overseas market. Order pipeline was also strong. This poses further earnings upside potential, supporting more share price rally. In addition, comparing to other AI names in the tech sector, expectation in the power equipment space was also not as high, providing attractive risk-reward profile. We are fundamental driven, bottom up, mainly looking at company specific. We will not do top-down investments in sector or regional allocation due to macro factors. Stock selection is the key to our performance. We mainly look at growth, quality, and valuation in selecting stocks. We have growth and quality bias as we like companies with strong growth. In addition to cyclical growth, we indeed prefer those with structural growth potential, which could also serve as the buffer in case of down market. Such structural growth could be from market share gain, new product development, etc. In terms of quality, we like those with high management quality, strong track records in earnings delivery, as well as strength in financials and cash flow. Valuation is also another important factor, although we slightly underweight this factor. Typically, we look at PEG, which is price earning to growth ratio, as the key parameter, not just on the valuation at one point of time, but also the growth outlook in the coming years. And we adopt a sector-neutral approach, targeting at close to benchmark weightings on regional and sector allocation, avoiding heavy bets on one single theme or sector so as to reduce the risk of frequent market rotation in China. We believe this approach should allow us to deliver sustainable outperformance in long term.